Most people don't lose money in crypto. They lose themselves. The first time you turn $500 into $5,000, something dangerous happens. Not in your wallet, in your brain. And if you don't understand this moment, those profits won't make you rich. They'll quietly destroy you. Stick with me, because by the end of this video, you'll see why your first win is actually the most expensive mistake you'll ever make in crypto. And if you want sharper insights, real strategies, and honestly some pretty absurd money truths, join our Telegram channel, link in the description. Let me tell you a story. Two people enter crypto at the same time. Same year, same market, same starting capital. Let's call them Alex and Daniel. Both start with $1,000. Nothing crazy, just enough to try it out. At first, nothing happens. Prices move slowly, charts look confusing. They watch YouTube videos, scroll Twitter, read threads they barely understand. But then, the market shifts. A random altcoin Alex buys at $0.03 suddenly jumps to $0.12 in a week. Daniel buys something similar. Same result. In less than 10 days, both of them are sitting on $4,000. Think about that for a second. They didn't work more hours. They didn't build a business. They didn't develop a skill. They clicked a few buttons and made 3 months of salary in a week. And this is where everything changes. Not financially, psychologically. Because the first profit doesn't just increase your money, it rewires your expectations. At this point, Alex does something very normal. He opens his calculator. Okay, if I turn $1,000 into $4,000 in 10 days, what happens if I do this again? He runs the numbers. $4,000 becomes $16,000, then $64,000, then $256,000. In his mind, he's already halfway to $1 million. And here's the dangerous part. It feels realistic, because he just did it once. And when something happens once, your brain starts believing it can happen consistently. This is the first trap. It's called recency bias. Your brain takes a short-term outcome and treats it like a long-term pattern. But crypto doesn't work like that. Markets don't reward consistency. They reward timing. And timing is mostly luck in the beginning. But Alex doesn't see luck. He sees skill. He starts thinking, maybe I'm actually good at this. Daniel feels the same thing. But here's where their paths begin to split. Alex decides to go all in. Not literally all his money, but all his attention. He starts checking charts every 10 minutes. Wakes up, checks price. Before bed, checks price. Middle of dinner, checks price. Because now, he has something to lose. And more importantly, he has something to chase. Daniel, on the other hand, feels excited, but slightly uncomfortable. Not because he lost money, but because he made it too fast. And that feeling, that quiet discomfort, is actually the most valuable signal in finance. But most people ignore it. Alex definitely does. Instead of slowing down, he speeds up. He increases position sizes. Instead of putting $200 into a trade, he puts $1,000. Because now, he's not thinking in percentages. He's thinking in outcomes. Why make $200 when I can make $2,000? And this is where the second trap appears. Your risk tolerance expands faster than your intelligence. You start taking bigger risks without actually understanding more. It just feels easier because you've already won. Let me explain this in a simple way. If you go to a casino and win your first bet, you don't walk away. You increase the bet. Because now it feels like house money, even though it's your money. Same thing here. Alex looks at his profits and thinks, I'm playing with gains now. But money doesn't have memory. The market doesn't care if it was profit or initial capital. Loss feels the same, but your brain treats it differently. So Alex takes a bigger trade, and for a moment, it works again. Another win. Now his account hits $7,500, and this is the exact moment where people get hooked. Not when they win, but when they win twice. Because once is luck. Twice feels like a system. Now Alex is convinced. This is real. This is repeatable. This is my way out. He starts calculating his exit from his job. He starts thinking about quitting. He even tells a friend, I think I found something. And here's the irony. He did find something, but not what he thinks. He found volatility. and volatility feels like opportunity until it turns against you. Daniel, meanwhile, does something boring. He withdraws $2,000. Not all, just enough to feel it. He sends it to his bank account, waits a couple days, and then sees it sitting there. Real money, not numbers on a screen. And something clicks. This isn't normal. This pace doesn't make sense. So instead of increasing risk, he reduces it. He keeps trading, but smaller, slower, more cautious. Alex does the opposite, because now he's chasing a feeling, not just money. The feeling of, I'm early, I'm smart, I figured it out. And that feeling is addictive, way more addictive than the money itself, because money satisfies you, but identity changes you. Alex no longer sees himself as someone trying crypto. He sees himself as a trader. And once you adopt that identity, you start behaving differently. You take trades you normally wouldn't. You justify risks you normally wouldn't. You ignore red flags. Because now it's not just about money. It's about proving something to yourself, to others, maybe even to people who don't care at all. And this is where the third trap quietly builds. You stop protecting your downside because you're obsessed with your upside. Let me show you what that looks like in numbers. Alex now has $7,500. He takes a 30% loss on one trade. That's $2,250 gone. Emotionally, it hurts, but not enough to stop. So he makes another trade, trying to recover. Classic mistake. Now another 20% loss. Now he's down to around $4,200, almost back where he started. But mentally, he's not at the beginning anymore. He's at the peak, looking down. And that changes everything, because losing money you never had feels worse than never having it at all. That's called loss aversion, and it's one of the most powerful forces in financial behavior. People don't chase profits, they chase the recovery of lost profits. Alex is no longer trying to grow his account. He's trying to get back to $7,500, and that shift is what destroys most traders, because now every decision is emotional. Every trade has pressure. Every loss feels personal. Daniel, he's still around $4,000 because he reduced risk early. He's not excited anymore, but he's also not stressed. And here's the key difference. Alex is riding a roller coaster. Daniel is walking uphill. One feels exciting, the other feels boring, but only one leads somewhere stable. And if you zoom out, this entire story has nothing to do with crypto. It's about what happens when humans experience fast money. Because fast money doesn't just change your account, it changes your baseline. What used to feel like a good return now feels slow. What used to feel risky now feels normal. And before you realize it, you're not investing anymore. You're escalating. And escalation always ends the same way. Not with one big loss, but with a series of small decisions that quietly undo everything you built. Think about that. Because the most dangerous thing about your first crypto profits is not losing them. It's what they convince you to do next. Now here's where the story gets uncomfortable. Because for a while, Alex doesn't lose everything. He stabilizes. After those losses, he slows down just a little. Not because he learned discipline, but because he's scared. He tells himself, okay, I'll be smarter now. And for a few weeks, it almost looks like he is. He wins a couple trades, small ones. $300 here, $500 there. Nothing crazy, but enough to rebuild confidence. And that's actually worse. Because small wins after losses don't teach discipline. They restore illusion. Now Alex believes he's back. He starts thinking the losses were just mistakes. Bad entries. Wrong timing. Next time I'll do it better. But the real issue was never timing. It was behavior. And behavior doesn't fix itself just because you got lucky again. So slowly, almost invisibly, he starts increasing risk again. Not in one big jump, but step by step. $500 per trade becomes $800. Then $800 becomes $1,200. And here's how it feels from the inside. Completely justified. Because now he has experience. He's watched charts for weeks. He knows the patterns. He recognizes setups. At least, that's what he tells himself. But there's something nobody tells beginners. In volatile markets, pattern recognition feels like skill, even when it's just randomness wearing a disguise. It's like seeing shapes in clouds. Your brain is designed to find meaning. even when there isn't any. So Alex starts seeing signals everywhere. This looks bullish. This is a breakout. This is support. And sometimes he's right, which makes it worse, because every correct guess reinforces the belief that he knows what he's doing. Meanwhile, Daniel is doing something almost boring. He stops trying to predict. Instead, he starts asking a different question. How much can I afford to be wrong? That one shift changes everything, because now the focus is not on winning, but on surviving. Daniel starts limiting his downside. No trade risks more than 5% of his portfolio. He doesn't chase pumps. He doesn't buy random coins just because they're trending. He misses opportunities, a lot of them. And this is where most people fail, not because they lose, but because they watch others win. Alex sees coins doing 2 times, 3 times, even 5 times in days, and he feels it. That pressure, that quiet voice saying, "You're missing out." This is the 4th trap. FOMO, fear of missing out. And it's not just emotional, it's mathematical. Because every missed opportunity feels like a loss, even though you didn't lose anything. Think about that. If a coin goes from $1 to $5, your brain calculates the profit you could have made and treats it like money you lost. So Alex starts chasing. He buys late. He enters after the pump because he doesn't want to miss the next one. And sometimes it keeps going up, which reinforces the behavior. But most of the time, it doesn't. It drops fast. And now Alex is stuck in bad positions, holding coins he doesn't understand, waiting for them to come back, because selling would mean admitting he was wrong. And that's another psychological trap. Ego. People think trading is about intelligence. It's not. It's about accepting that you're wrong, over and over again, without letting it destroy you. But Alex can't do that, because now it's personal. Every trade is a statement. Every loss is an attack on his identity. So instead of cutting losses, he holds, and holding turns small mistakes into big ones. Let me give you a simple example. Alex buys a coin at $2. It drops to $1.60. Instead of selling, he tells himself, it'll bounce. Then it drops to $1.20. Now he's down 40%. Selling now feels impossible because the loss is too real. So he waits. And this is how people get trapped. Not by one bad decision, but by refusing to accept a small loss early. Daniel does the opposite. He sells quickly, even when it hurts, especially when it hurts, because he understands something most people don't. Small losses are the cost of staying in the game. Big losses remove you from it. And over time, this difference compounds, not just financially, but emotionally. Alex becomes reactive. Every move is urgent. Every decision feels heavy. He starts revenge trading, trying to win back what he lost. And revenge trading is dangerous because it removes logic completely. Now it's not strategy, it's emotion. Meanwhile, Daniel is calm, not because he's smarter, but because he reduced the stakes. When you risk less, you feel less. And when you feel less, you think better. This is the part nobody wants to hear. The goal in volatile markets is not to maximize profit. It's to minimize stupidity, because stupidity is what blows accounts, not lack of opportunity. And here's where things finally break. One night, Alex finds a perfect setup. Everything aligns. Indicators, volume, social hype. It feels obvious. So he goes big. $3,000 into one trade, almost his entire account, because in his mind, this is the moment. This is the one that gets me back. And for a few hours, he's right. The price goes up. 10%, 20%. He's watching his screen, heart racing, already thinking about how much he'll have by morning. And then it reverses, fast, violently. Within minutes, the price crashes, liquidity disappears, and just like that, he's down 40%, then 50%, then more. He freezes, doesn't sell, can't sell, because his brain is still anchored to the peak. He keeps thinking, it'll come back, but it doesn't. And by the time he finally exits, he's left with less than $2,000 from $7,500, from a peak that once felt like the beginning of something big. Gone, not in one moment, but in a chain of completely understandable decisions. That's the part that matters. Nothing Alex did felt crazy at the time. Every step made sense. That's why it's so dangerous, because financial destruction rarely looks like a mistake while it's happening. Daniel? He sees the same setup. He almost takes it. But something stops him. Not fear, not hesitation, just a rule. No single trade can change my life. So he skips it. And the next day, he sees what happened. And instead of regret, he feels relief. Because he understands something Alex still doesn't. In markets like this, survival is the win. Everything else is optional. And if you zoom out, this is the real lesson. Your first crypto profits don't destroy you because you lose them. They destroy you because they teach you the wrong game. They teach you that fast money is normal, that big wins are repeatable, that risk is your friend. But in reality, fast money is the exception. And the moment you treat it like the rule, you start making decisions that guarantee you'll give it all back. And usually, a little more. And here's the part nobody talks about. What happens after the loss? Not the immediate reaction, not the "I messed up" moment, but the quiet phase that comes after. Because that's where the real damage sets in. Alex closes his app that night and just sits there. No panic, no yelling, just silence. Because when something hits you hard enough, your brain doesn't react right away. It pauses, almost like it's buffering reality. The next morning, he opens his account again. $1,870. He stares at it longer than he wants to admit. Because just a few weeks ago, that number used to excite him. Now it feels small, almost insulting. And this is the fifth trap. Your reference point has changed. You're no longer comparing yourself to where you started, you're comparing yourself to your peak. And peaks are dangerous because they distort reality. Alex didn't lose $1,000. He lost $5,600 in his mind, even though most of that money was never real in the first place. It was just temporary market movement. But psychologically, it was his. And now it's gone. So what does he do? He tells himself something that sounds responsible. I just need to take a break. And for a few days, he does. He stops trading, stops checking charts, tries to reset. But here's the problem. He's not actually letting go. He's waiting. Waiting for the feeling to fade. Waiting for confidence to come back. Waiting for the next opportunity. Because deep down, he still believes the same thing. I can get it back. That belief never left. It just went quiet. And this is where people either evolve or repeat the cycle. Daniel also experiences something interesting around this time. Not loss, but boredom. Because his strategy works. But it's slow. His account goes from $4,000 to maybe $4,300, then $4,100, then $4,500. Small movements, no excitement, no big dopamine hits. And for a moment, he questions it. Am I being too careful? Should I take more risk? Because when you're surrounded by stories of people making 10 times, discipline feels like hesitation. But Daniel does something most people don't. He zooms out, he stops looking at days, and starts looking at direction. And the direction is clear. Slightly up, slightly stable, no drama, no crashes. And that's when it clicks. This is sustainable. Not exciting, not impressive, but repeatable. Meanwhile, Alex comes back. Of course he does. Because markets don't just take your money. They leave the door open, they give you hope. And hope is dangerous when it's tied to money. He deposits another $1,000. Fresh start, new mindset. This time I'll be smarter. And this is where the cycle resets. But here's the key difference. He's not starting from zero mentally. He's starting from frustration, from pressure, from something to prove. And that makes every decision heavier. Now every trade has a hidden goal. Get back to where I was. And that goal is toxic. Because it forces you into aggressive behavior. You don't want slow growth. You want recovery. And recovery requires risk. So even when Alex tries to be careful, he can't sustain it. Because patience doesn't feel good when you're behind. So within a week, he's back to taking larger trades. Not as big as before, but bigger than he should. And again, sometimes it works. A coin jumps, he makes $600, and instantly, the confidence returns. Not fully, but enough. Enough to say, okay, I'm back. And this is where the market traps people again. It gives you just enough success to keep you playing. Not enough to win, just enough to stay. Because the worst thing that could happen to the market is you quitting. So it doesn't let you quit. It gives you hope. And hope keeps you in the game, long enough to make the same mistakes again. Daniel, during this time, starts doing something different. He reduces trading even more. Not because he's scared, but because he realizes something subtle. The more he trades, the worse his results. Not dramatically worse, just slightly, but consistently. So he experiments, trades less, waits more, and his results improve. Not by making more money, but by losing less. And that's when it really clicks. Profit isn't about how much you win, it's about how much you don't lose. That's a completely different game, because now the goal is not to chase opportunities, it's to filter them. Most trades are noise, a few are good, and even fewer are worth taking. Meanwhile, Alex is doing the opposite. He's increasing frequency, more trades, more action, because he thinks activity equals progress. But in markets, activity often equals mistakes. Think about it like this. If you make 50 decisions a day, some of them will be bad. If you make 5 decisions a day, you can actually think through them. Quality goes up, stress goes down, but most people don't want fewer decisions. They want more chances, because more chances feel like more opportunity. Even though mathematically, it often leads to worse outcomes. And slowly, Alex starts bleeding again. Not one big loss, just small cuts. Minus 10% here, minus 15% there. Fees, slippage, bad entries. It doesn't feel catastrophic, which is exactly why it's dangerous, because he doesn't notice the pattern. Until one day, he checks his account, and it's back near $1,500. And this time, it hits differently. Not shock, not panic, just exhaustion. Because now it's not about one mistake. It's about repetition, the same cycle, the same emotions, the same outcomes. And this is where most people quit. Not at the bottom, but when they realize they've been here before and nothing changed. Daniel doesn't quit, but he changes something important. He stops trying to beat the market and starts trying to work with it. Longer time frames, fewer trades, more patience, less noise, and slowly, almost invisibly, his account grows. $4,000 becomes $5,000, then $6,200, then $7,000. No spikes, no viral moments, just steady progress. And here's the ironic part. At some point, Daniel reaches $7,500, the same number Alex once had, but it feels completely different. No excitement, no rush, just normal. Because it took time, and time changes how money feels. Fast money creates emotion, slow money creates confidence, and confidence is what actually builds wealth. Not hype, not luck, not timing, just the ability to stay consistent long enough for the math to work. And if you step back for a second, this whole story becomes very simple. Alex was trying to win fast. Daniel was trying not to lose. One was chasing outcomes, the other was managing behavior. And in the short term, chasing feels better. It's exciting, it's addictive, it feels like progress. But in the long term, it collapses. Because it's built on unstable decisions. While boring, methodical, almost frustrating discipline quietly compounds into something real. And this is the part most people never accept. The market doesn't reward intelligence. It rewards emotional control. Because the opportunities are the same for everyone. The difference is how people respond to them. And if you don't fix the way you respond, your first profits won't be the beginning of your wealth. They'll be the beginning of a cycle. That keeps you busy, keeps you hopeful, but never actually moves you forward. And here's where the story finally lands. Not in the market, but in real life. Because after a few months, something subtle happens. Alex stops talking about crypto. Not publicly, not dramatically, he just goes quiet. No more messages to friends about this next coin. No more late-night chart screenshots. No more excitement. And if you ask him about it, he'll say something like, "Yeah, it's kind of risky," or "I think it's all manipulated." But that's not really what happened. What actually happened is much simpler. He got tired. Not physically, mentally. Because losing money isn't what drains you. Chasing it does. The constant thinking, the constant checking, the constant emotional swings, up, down, hope, regret, excitement, frustration, over and over again. That cycle burns people out. And eventually they don't quit because they understand the market. They quit because they don't trust themselves anymore. And that's the real loss, not the $5,000, not even the time, the loss of confidence in your own decisions. Because once that's gone, everything feels uncertain, even outside of crypto. Alex starts hesitating more, overthinking small financial decisions, questioning himself, because somewhere in his mind, there's this quiet thought. I thought I knew what I was doing, and I didn't. And that sticks. Daniel's path looks completely different. Not impressive, not dramatic, but stable. And stability starts showing up in places that have nothing to do with crypto. He sleeps better, doesn't check prices first thing in the morning, doesn't feel that constant pull to see what's happening, because nothing urgent is happening. And that's the point. His money is working, but it's not demanding attention. And that creates space, space to think, space to live, space to focus on things that actually matter. And over time, his relationship with money changes. It's no longer something exciting. It's something reliable, predictable, almost boring. And that's when real wealth starts forming, not just in numbers, but in mindset. Because once you stop needing excitement from money, you stop making emotional decisions. And when you stop making emotional decisions, the math finally starts working in your favor. A year passes. Alex barely remembers specific trades, just fragments, a coin that pumped, a crash, a night he couldn't sleep. It all blends together because high-intensity experiences fade fast, especially when they're stressful. But the feeling stays, that mix of regret and what if. Daniel also doesn't remember every trade, but for a different reason. Nothing extreme happened, no big wins, no big losses, just consistent movement. And consistency doesn't create strong memories, it creates results. His account isn't explosive, but it's real, and more importantly, it's intact. And here's the part most people miss when they look at stories like this. It's not about who made more money in the beginning. Alex actually did. It's about who kept it. And that's the whole game, because making money is easy in volatile markets. Keeping it is where skill shows up. And skill, in this context, doesn't look like intelligence. It looks like restraint. It looks like saying no more often than yes. It looks like sitting out when everyone else is jumping in. It looks like being okay with missing opportunities. That's the part nobody posts about. Nobody brags about the trades they didn't take. Nobody celebrates the money they didn't lose. But that's where the real edge is. And if you zoom out even further, beyond crypto, beyond trading, this pattern repeats everywhere. In business, in investing, in life, people get early wins and misinterpret them. They think the win came from skill, when it came from timing, luck, or environment. And then they try to replicate it, scale it, turn it into a system. But the conditions that created the win aren't there anymore. And that's when things break. Not immediately, gradually, quietly, just like Alex. And the truth is, most people don't fail because they're stupid. They fail because they learn the wrong lesson from success. That's the real danger. Not failure, but misunderstood success. Because failure makes you question things. Success makes you believe things. And belief, when it's wrong, is expensive. So if there's one thing you take from this entire story, let it be this. Your first crypto profits are not a signal that you figured it out. They're a test of how you react to easy money. A test of whether you speed up or slow down. A test of whether you protect what you have or risk it trying to get more. And most people fail that test, not because they don't want to win, but because they don't realize what game they're playing. They think it's a game of maximizing returns. It's not. It's a game of controlling behavior, because the market will always offer opportunities. That's not the problem. The problem is what those opportunities make you feel and what those feelings make you do. And if you can master that, if you can stay calm when things move fast, if you can stay patient when things feel slow, if you can walk away when everything in you wants to chase, then it stops being about crypto. It becomes about discipline. And discipline is the only thing that compounds without limits. Everything else comes and goes. Trends change, markets shift, opportunities disappear. But the ability to control yourself in moments of uncertainty, that stays. And that's what actually builds wealth. Not the first win, not the lucky trade, not the big breakout, just the quiet decision, repeated over and over again, to not let temporary success turn into permanent damage. Think about that. Because most people are not one bad trade away from losing money. They're one good trade away from starting a cycle that does.